You know, we often just assume in finance that getting more information is always better, especially with company earnings.
Right. More details, clearer picture. Seems obvious.
And you see regulators like FASB and the SEC pushing for more granularity, more disaggregation in financial reports.
Exactly. And if you're someone trying to, get a quick, solid handle on a company's performance,
Yep.
you've definitely noticed this. Reports getting longer, more line items. It can feel a bit overwhelming sometimes.
It really can. Which brings us right to the core of today's deep dive, is all this extra detail, this disaggregation, actually helping us as investors? I found this really interesting study that, well, it questions that very assumption.
We did. It's called, Is All Disaggregation Good for Investors? Evidence from Earnings Announcements. And it suggests the answer isn't just a simple yes.
So our mission today is pretty clear.
Yeah.
Let's try and understand when breaking down earnings helps investors and, maybe more importantly, when it might actually hinder understanding and decision-making.
Sounds good. Because the traditional view that one we mostly operate under
Yeah.
is that more disaggregated data is purely positive. Better informed investors, more efficient stock prices, more accurate earnings forecasts, better valuations, the whole package.
Hey, let's just unpack that for a second. The logic is that by splitting up the main earnings figure, you're separating out parts that behave differently.
Right, precisely. You isolate components with different characteristics. Think sales versus cost of goods sold, or operating costs versus, say, interest expense. They have different drivers, different persistence.
So separating them lets you analyze each piece better. Makes sense.
That's the standard argument. But this study throws a bit of a wrench in the works. It introduces a new hypothesis.
Okay, I'm intrigued. What's the new angle? What's the potential downside they're looking at?
Well, their central argument is this. What if you disaggregate components that are actually very similar in nature, things they call homogeneous?
Homogeneous components.
Breaking those out, they argue, might not just be unhelpful, it could actually be detrimental. It might lead to more investor disagreement and a less efficient market reaction when earnings are announced.
Wow, okay, so homogeneous versus heterogeneous disaggregation. That sounds like the absolute P here. How did the researchers actually tell these two apart?
Yeah, it's crucial. They used a clever method based on persistence.
Persistence,
Meaning how well a specific earnings component predicts future earnings, especially relative to how well sales predict future earnings.
Ah, okay, so predictive power.
Exactly. So heterogeneous components are the ones with persistence that's significantly different from the persistence of sales.
Meaning they offer unique information. Something sales figures alone don't capture.
You got it. They bring something distinct to the table for forecasting, a different signal.
Right. And homogeneous.
Homogeneous components are those where the persistence is statistically quite similar to that of sales.
So breaking them out might be redundant.
Kind of, yeah. The implication is you're getting more detail, but it's not necessarily giving you fundamentally new predictive insight beyond what the overall sales trend already tells you. It's like different shades of the same color, as you said earlier.
Okay, that helps clarify it. So how do they actually identify these in practice? What was the method?
They looked at industry-level data using 5-year rolling quarterly regression.
Rolling regressions, okay.
Yeah, so for each industry, they'd look back 5 years, quarter by quarter, and analyze how components like, cost of goods sold, COGS, SG&A, depreciation, how their persistence compared to the persistence of sales for that industry during that period.
And the key test was whether the component's persistence was statistically different from sales persistence.
Exactly. If it wasn't significantly different, they tagged it as homogeneous for that industry and time. If it was different, it was heterogeneous.
Interesting. Did they find any general patterns? Like, are certain types of expenses usually homogeneous?
They did. They found that components within operating income, things closely tied to the core business.
Like COGS and SG&A.
Precisely. And depreciation, too. Those were more likely to be homogeneous. Their persistence often tracked sales persistence quite closely.
Makes sense.
And heterogeneous.
Those were more often the non-operating items. Things like tax expenses, interest income or expense, special items, one-offs. Those tended to have persistence patterns quite distinct from sales.
Okay, that distinction between operating and non-operating seems pretty important then. So once they could classify components, how did they measure how much homogeneous disaggregation a company was actually doing in its earnings announcement?
Good question. They compare the earnings announcement itself to the later, more detailed 10Q or 10K filing.
Ah, the official regulatory filing.
Right. They calculated a ratio. The number of homogeneous components disclosed in the announcement divided by the total number of homogeneous components disclosed in the later filing.
So a higher ratio means the company highlighted more of those similar persistence items up front. Exactly. It controls for what eventually needs to be disclosed anyway, focusing on what they choose to emphasize in that initial, often voluntary announcement.
Yeah. And the million-dollar question: what happened when they linked this measure to investor reactions?
This is where it gets really compelling. They found a significant positive relationship between the level of homogeneous disaggregation and measures of investor disagreement right after the earnings announcement.
More homogeneous detail, more disagreement. How did they measure disagreement?
The main measure was standardized unexpected volume, or SUV.
SUV, okay.
Think of it as a proxy for how much trading volume deviates from the norm around the announcement. Higher SUV suggests investors have more varied opinions, more disagreement about what the earnings news actually means.
So showing more of this similar nature detail seemed to correlate with more unusual trading activity, implying investors weren't all on the same page.
That's exactly the interpretation. And they didn't just rely on SUV, they looked at other things too.
Like what?
Market-adjusted turnover, dispersion among analyst forecasts, even analyst forecast errors.
And the results?
Generally consistent. More homogeneous disaggregation tended to link up with higher disagreement across these different measures.
Wow. Okay, but what about the other side? The heterogeneous stuff? The truly different information?
Interestingly, they often found the opposite effect there. Heterogeneous disaggregation was frequently negatively associated with disagreement.
Meaning it reduced disagreement, helped investors align.
It seems so, which really highlights their core point. Breaking out truly distinct information seems helpful, clarifying. Breaking out similar information seems to potentially confuse or muddy the water.
That makes a lot of sense. So if there's more disagreement with homogeneous disaggregation, what does that do to market efficiency?
No.
Did they look at how quickly prices adjusted? You mentioned post-earnings announcement drift.
They did, PE. And as you know, PE is generally seen as a sign of market inefficiency. The price kind of slowly drifts towards the correct level instead of jumping there immediately.
Right, the market isn't fully digesting the news right away.
Exactly. And their finding was that greater homogeneous earnings disaggregation was associated with greater PE.
So more the similar detail, a slower, less efficient market response.
That's the implication. It's like the extra noise from the homogeneous components slows down the market's ability to fully incorporate the earnings surprise into the price. More disagreement seems to lead to this slower adjustment.
Okay, but what about when the full 10Q or 10K comes out later with all the mandatory details? Does that resolve things?
That's another really interesting finding. They observed that the spike in disagreement around the initial announcement, the part linked to homogeneous disaggregation, it tended to decrease around the time the subsequent 10Q or 10K was filed.
So the market does eventually sort it out when it gets the full picture.
It seems to help resolve some of that initial confusion, yes. The more comprehensive mandatory disclosures provide clarity that maybe the initial selective homogeneous breakout lacked.
But the initial confusion still happened.
Right. And they noted the initial increase in disagreement was generally larger than the subsequent decrease. So it's like the initial noise creates a bigger disruption than the later clarification fully undoes.
Gotcha. Now, a key question with studies like this is always causality, right? Could something else be driving both the disclosure choices and the market reaction? Did they try to control for that? Endogeneity.
Absolutely crucial point. And yes, they did quite a bit of work on that. They ran numerous robustness checks.
Like what kind of checks?
They used techniques like propensity score matching and entropy balancing. These try to create better comparison groups, matching firms that use high homogeneous disaggregation with similar firms that don't.
To isolate the effect of the disaggregation itself.
Exactly. They also used an instrumental variable approach.
What was the instrument?
They use the lagged industry average level of disaggregation. The idea is that what competitors did last period might influence a firm's choice now, but it shouldn't directly affect its current market reaction, other than through its own disclosure choice.
Clever. And did the main results hold up through all these tests?
Largely, yes. The core findings that homogeneous disaggregation is linked to increased investor disagreement and greater PED remain statistically significant across these different quite rigorous methods.
Okay, that definitely adds weight to their conclusions. So let's talk practical implications. What does this mean for, say, regulators like the FASB and SEC?
Well, it suggests caution is needed. Just pushing for more disaggregation across the board might not be the best approach, especially for those operating income items that tend to be homogenous.
Because it could backfire, create more confusion instead of clarity.
Potentially, yes. It could lead to unintended negative consequences like increased disagreement and less efficient markets. The takeaway for them is maybe to focus more on the type and quality of disaggregation, encouraging the breakout of truly heterogeneous information.
And what about company managers, the ones actually putting these reports together?
For managers, it highlights the need to be thoughtful about what they choose to break out, especially in earnings announcements or other voluntary disclosures. Simply providing more line items isn't automatically better.
Quality over quantity, maybe.
Exactly. Focusing on disaggregating components that genuinely provide different insights into performance might be more effective than just slicing up operating income more finely if those slices all move together anyway.
Okay, and finally, for you, the listener, trying to make sense of all this financial data efficiently, what's the takeaway?
I think the key insight for you is that more detail isn't always more valuable. You need to be a critical consumer of this information.
Don't just assume more granular means better insight.
Right. Be aware that sometimes very detailed breakdowns, especially of operating items, might actually reflect more disagreement or noise rather than fundamental new information. It encourages you to ask, is this detail telling me something genuinely different?
Okay, so let's boil it down. The big takeaway seems to be, not all earnings disaggregation is created equal.
That's it in a nutshell.
Breaking out those homogeneous components, the ones similar in persistence to sales, might actually increase investor disagreement and make market reactions less efficient.
Exactly. Whereas breaking out heterogeneous components, the truly distinct ones, seems more likely to be helpful.
And for you, trying to learn efficiently, knowing this difference, helps you focus your attention on the details that likely matter most, the ones providing real, unique insight.
It helps you cut through some of the potential noise, become a smarter interpreter of financial reports.
So here's something to think about. How can we, as investors or analysts, get better at spotting the difference? How do we identify that truly valuable heterogeneous disaggregation versus the potentially less useful homogeneous kind when we're looking at an earnings release?
That's the critical question, isn't it? Maybe it involves looking beyond just the line items themselves and thinking about the underlying business drivers. Does this specific breakdown really tell a different story about costs, margins, or risks compared to the overall revenue trend?
Asking ourselves, what new piece of the puzzle does this detail actually give me?
Precisely. This research gives us a framework for asking that question more critically. It's a great starting point for developing that more discerning eye when you approach financial information.